Okay, so for this next video lecture, so we will be focusing on the discussion about finance functions. Okay, so the following are the finance functions. Okay, so first is investment decision. So here, this is considered to be one of the most important functions of finance. So this is on how to intelligently or efficiently allocate capital in procuring or purchasing or acquiring long-term assets. So this activity is also known as capital budgeting, because here we will be dealing with investing a large amount of capital for us to acquire fixed assets or long-term assets. Okay, so of course, just like what we have mentioned in our previous video lecture, so here, before a decision is to be made if a purchase should be pursued, the management should first determine or compute the net benefit, okay, of using or purchasing this particular asset. Okay, so the benefit should outweigh or exceed the cost in order for this decision to be acceptable. So it is also important to allocate capital in the long-term assets for as long as they will get a maximum yield or benefit in the future. So this is what we are talking about earlier. So following are the two aspects of investment decision. So the first is the evaluation of the new investment in terms of profitability. So this is how you evaluate if a particular decision to purchase, for example, is or will be accepted. So we will test the profitability of using that long-term assets. Okay, so if it will yield us or provide us with benefit that is greater than the cost, then it will be pursued. Second is we can also compare cut-off rate against new investment and prevailing investment. So here you can use the return on investment of this of using this asset and the acceptable or prevailing return on investment rate, okay, that is related also to the use of that asset in the industry or in the market. Okay, so the goal here is to at least equate or be the rate or the return on investment of purchasing this asset should be equal, at least be equal with that of the prevailing rate or even exceed, okay, to be better. Okay, so investment decision is not only involved in allocating capital in the long-term assets. So they also include decisions of using this capital or fund which are obtained by selling those assets which become less profitable and less productive. So aside from the decision of investing in the long-term assets, investment decisions also covers our old or less profitable and less productive asset, okay, which can be sold. Okay, so that's also part of the investment decision, because in this case it can be that we can keep this less profitable and less productive asset and use it still by having maintenance, meaning to say we have to invest as well in recurring and regular maintenance for it to be still used in the operation, or we can sell that and purchase another or new assets. Okay, so the second function of finance is financial decisions. So here, this is also considered to be an important function which the financial manager must perform. So this is important to make wise decisions about when, where, and how should a business acquire fund. Okay, so for the investment decision, we are after, or we are concerned with the investment in the long-term assets. Here, under the financial decision, we are concerned with the source of capital and how to acquire those needed funds. So these funds can be acquired through many ways and channels. So here, as mentioned in our introductory part of this module, we've mentioned about the two main sources of funds in a corporate finance. So basically, this is from the equity or debt or loan or bonds. So this portion of a firm's financial statement, the long-term debt or liability and the equity capital is what we call the capital structure. Okay, because this is where the entity usually acquire their needed additional funds or investment. So from their investor, from the equity, and from their creditor using loan or borrowing or bonds. Okay. So a sound financial structure is said to be one which aims to maximize shareholders' return with minimum risk. So here, when we say sound financial structure, we have to make sure that most of our capital source will be coming from our investors, so that the claim over our asset will be greater, okay, for the investor and lesser for our creditor. Okay, so that is considered to be a sound financial structure. So with minimum risk, meaning to say there are less claims from the creditors, lesser interest to be paid from outside creditors, and more claims to the investors. So in such a scenario, the market value of the firm will also be maximized, and therefore this is considered as the optimum capital structure. Okay, so this is achieved in that ratio. Okay, so the next function of finance is the dividend decision. So here, for a company or for a corporation, earning a profit or positive return is a common aim. Okay, as mentioned also earlier. But the key function of financial manager in this case of profitability is also to decide whether to distribute all the profit to the shareholders in the form of dividend or retain the profits in the business to be used as additional fund, or distribute part of the profit to the shareholder and retain part of it to the business. So basically, the dividend that the enterprise or the corporation distributes to their shareholders are coming from our profit. So in the structure of a corporation, in their shareholders equity section, so we have what we call retained earnings. So this is where profits and other related accounts are being consolidated. So here, this balance under the unrestricted retained earnings portion, so the management can get from there an amount to be distributed to the shareholders in the form of dividend. But this should also be provided or approved, okay, by the board before it can be distributed. Okay, so here this decision is also an important finance function because when we decide to provide or give dividend, so it will also be an indication, okay, that the company is doing well in performing their business operation, because they are able to return a part of their profit to their shareholders. So this is also related to wealth maximization on the part of the shareholders. Okay. However, this decision is very important because they should consider if that is beneficial for the overall organizational goals and objectives. Okay, so dividend decision is the financial manager's responsibility to decide an optimum dividend policy which maximizes the market value of the firm as well. Okay, so the next finance function is liquidity decision. So here, this is also considered to be an important concern. Okay, so to maintain a liquidity position of a firm to avoid insolvency. So here, when we say liquidity, this is how the business entity is able to pay their current obligation when they fall due. So this is a very important decision, because if the company is not able to pay for their obligations, so this will result into losses, okay, and of course having to sacrifice some of their assets in order to pay for such liability. So in this case, if that is their status, meaning to say they are not financially healthy anymore. Okay, so the firm's profitability, liquidity, and risk are all associated with investment in current assets. Okay, so this is how they utilize their assets, okay, in generating profits, which will give them profit. Liquid means say they have enough cash balance to pay for their liability. Okay. So in order to maintain a trade-off between profitability and liquidity, so it is important to invest sufficient funds in our current assets, but we have to make sure that a portion of our total assets must also be balanced. Okay, so meaning to say we should not always put more investment in current assets. We should also allocate this to other assets such as non-current or long-term assets. Okay, because in this case, for example, if we have too much cash, so this is not also good for the company because it is susceptible to theft by the employees. Okay, and this might be used and this can be or might be used in some investment that is not beneficial to the company. Okay, so but since current assets do not earn anything for business, so therefore a proper calculation must be done. So this is what we are talking about. Okay, in investing in current assets. So current assets should properly be valued and disposed from time to time once they become non-profitable. So this is especially for example, in our receivables, these should be turned and collected. Okay, it should not be stagnant, especially in the long run, because this will indicate that our balances or the accounts from our customers are not collectible, and this may also result into losses. So that is not good. As well as in our inventory, we should always make sure that they are, or the turnover is fast, meaning to say we are able to sell those inventories and convert it into cash in a small or in a short period of time as possible. So current assets must be used in times of liquidity problems and especially in times of insolvency. So they can be used. We also have to make sure that they can be used to pay for the liabilities. So we can actually we can pay using our accounts receivable and inventory aside from cash. Okay, so those are the different finance functions.